Tokenomics, after regulation, from protocol revenue to token holder value. Flint West reporting. The crypto industry spent years learning how to generate revenue under regulatory uncertainty. The next chapter is learning how to return that revenue to token holders. Section 1. For much of the industry's history, the primary challenge was proving that decentralized protocols could become viable businesses. Today, many of them have succeeded. Decentralized exchanges, lending markets, derivatives platforms, liquid staking protocols, and launchpads are collectively generating billions of dollars in annual protocol revenue. The question is no longer whether crypto can generate cash flow. The question is who ultimately owns it. Section 2. The first generation of crypto investing focused almost exclusively on narratives. Projects were valued based on technological promises, token issuance schedules, total value locked, user counts, or social media momentum. Revenue was often an afterthought. That is beginning to change. Institutional research firms are increasingly evaluating crypto protocols using familiar business metrics, such as market capitalization divided by trailing 12-month revenue, the crypto equivalent of the traditional price-to-sales ratio. This represents an important evolution. Crypto protocols are gradually being viewed less as speculative tokens and more as operating businesses capable of generating recurring cash flows. Section 3. At this point, the following grayscale chart helps illustrate exactly what that transition looks like in practice. The chart ranks the 15 highest revenue-generating crypto protocols based on the last 12 months of protocol revenue. Rather than focusing on token price, user numbers, or social media popularity, it asks a much simpler question. Which crypto protocols are actually making money? The chart then compares each protocol's annual revenue with its circulating market capitalization to calculate a revenue multiple. This is the crypto equivalent of the traditional price-to-sales ratio used by equity investors. A lower multiple generally means investors are paying less for each dollar of revenue, while a higher multiple suggests the market expects stronger future growth, a more durable competitive advantage, or superior value accrual to token holders. Several protocols stand out. Hyperliquid sits comfortably at the top, generating approximately $871 million in annual protocol revenue, while trading at a valuation of around 15 times revenue. The market is clearly assigning a premium to its dominant position in perpetual futures trading and its continued growth prospects. By contrast, protocols such as Pump.Fun, PancakeSwap, and Meteora are trading at approximately 1 times annual revenue. In simple terms, investors are paying roughly $1 of market value for every dollar of annual protocol revenue. Grayscale highlights these as examples of potentially low valuation multiples compared with many traditional growth businesses. However, revenue alone does not tell the whole story. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 4. The more important question is whether that revenue actually benefits token holders. Some protocols use buyback and burn programs, where protocol revenue is used to purchase tokens on the open market before permanently removing them from circulation. Others distribute value through staking rewards, treasury growth, fee sharing, or governance-controlled mechanisms. Some retain a larger proportion of revenue to fund future development and ecosystem expansion. These different approaches mean that two protocols generating identical revenue may deserve very different valuations. The chart therefore represents only the starting point of the analysis. Section 5. The next question investors should ask is, how efficiently does each protocol convert protocol revenue into token holder value? That is likely to become one of the defining questions of the next generation of crypto investing. As regulation becomes clearer and the industry matures, investors may spend less time asking which protocols generate the most revenue and more time asking which protocols have the clearest, most transparent, and most sustainable mechanisms for returning that economic value to their owners. Section 6. Revenue alone, however, does not automatically create value for token holders. A protocol may generate hundreds of millions of dollars each year, while token holders receive little or no direct economic benefit. This exposes a distinction that is likely to become increasingly important. Protocol revenue is not the same as token holder value. Revenue simply measures the economic activity occurring inside the protocol. Value accrual describes how much of that economic output ultimately reaches those who own the token. These are two very different questions. To understand why, it is necessary to appreciate the regulatory environment in which much of crypto evolved. Section 7. For years, many projects operated under what participants often described as regulation by enforcement. Rather than designing tokenomics purely for economic efficiency, protocol designers also had to consider legal uncertainty. Mechanisms that looked too similar to traditional dividends or shareholder distributions risked attracting regulatory attention. As a result, many protocols adopted increasingly complex systems involving governance tokens, treasury accumulation, staking rewards, liquidity incentives, fee rebates, vote escrow token structures, and other indirect methods of distributing value. Many of these mechanisms were not necessarily economically optimal. They were, at least in part, responses to an uncertain legal environment. As regulatory frameworks become clearer, protocol designers may be free to optimize for economic transparency instead of legal ambiguity. This could simplify tokenomics considerably. One increasingly attractive approach is the buyback and burn model. Under this structure, protocol revenue is used to purchase tokens from the open market before permanently removing them from circulation. The result is a direct and transparent relationship between protocol success and token scarcity. For investors, the signal is easy to understand. If protocol usage increases, revenue increases. If revenue increases, buybacks increase. If buybacks increase, the circulating supply declines. The connection between business performance and token holder value becomes visible. Historically, investors asked, does this protocol generate revenue? That remains an important question, but it is no longer sufficient. The more valuable question may become, by what mechanism does protocol revenue become token holder value? Some protocols may favor buyback and burn. Others may distribute revenue through staking rewards, treasury ownership, fee sharing, or alternative value accrual mechanisms. The specific implementation may differ. The underlying principle does not. Economic output must have a credible path back to token holders if the token is to represent an ownership claim on the protocol's success. Section 8. Crypto is entering a new phase of maturity. The first chapter was about building decentralized infrastructure. The second was about proving that these networks could generate sustainable revenue. The third may be about something even more fundamental: establishing clear, transparent, and measurable pathways that convert protocol revenue into token holder value. As the industry matures, investors may spend less time asking which protocol earns the most revenue, and more time asking which protocol returns the greatest proportion of that revenue to its owners. That transition could redefine how crypto assets are valued. In the years ahead, the most important innovation in tokenomics may not be generating more revenue. It may be making value accrual simpler, more transparent, and easier for every investor to understand. Flint West signing off.